Today, we're jumping into a topic that, let's be honest, can feel a little intimidating, but is absolutely crucial for any serious investor: stock options. We're going to be your guide through the first chapter of Colin Bennett's fantastic book, Trading Volatility, and really uncover the practical strategies that can take your portfolio from just sitting there to actually working for you.
So, we've all heard the advice 1,000 times, right? Buy good stocks and just hold on. And that's great advice until it's not. I mean, what do you do when the market just goes flat for months on end, or worse, when it starts trending down? Well, that's the classic investor's dilemma, and it's precisely where options can change the game.
So here's our game plan for today. We'll start with that exact dilemma. Then, we'll nail down the core concepts so we're all on the same page. After that, we'll get into the fun stuff, a playbook of actual strategies you can use. We'll touch on some real-world fine print, and then wrap it all up by showing you how this fits into your new financial toolkit.
Okay, let's get right into it. That buy and hold strategy, it's a superstar in a bull market, no doubt. But what happens when things get choppy, go sideways, or even drop? Suddenly, your only tool is to sell or do nothing. How are you supposed to generate returns or, protect what you've built in an environment like that?
And this is exactly where our source, Chapter 1 of Trading Volatility, comes in. It's written for people like us, investors who have a view on where a stock is headed. This isn't abstract theory, it's all about real-world application. We're talking about ways to boost your returns, shield your portfolio, or even get exposure to a stock in a much smarter, more capital-efficient way.
All right, before we get to all those cool strategies, we have to make sure our foundation is solid. Let's do a quick run-through of the absolute basics, the building blocks, so we're all speaking the same language.
And here's a fun fact. We tend to think of options as this super modern, complex financial invention, right? But the basic idea has actually been around since the 1690s in London. Of course, things got a whole lot more serious in the 1970s when the Black-Scholes-Merton formula gave us a way to price them logically, and the CBOE created a standardized exchange for everyone to trade on. That's when things really took off.
So, at its very heart, it's actually pretty simple. You've got two flavors. A call option is basically a bullish bet. It gives you the right, and this is so important, but not the obligation, to buy a stock at a certain price. A put option? It's the polar opposite. It's a bearish bet that gives you the right to sell a stock at a set price. That's it, bullish or bearish. And that set price we just talked about, that has a name. It's the strike price. Just think of it as the price that's locked into your contract. It's the anchor point for the whole trade, no matter what the actual stock price does. Now here is a massive difference from owning stocks. Every single option has an expiration date. It has a shelf life. After that date, poof, the contract is gone. This adds the element of time into the equation, which is absolutely critical for every decision you're going to make. You're also going to hear people talk about an option's moneyness. It sounds complicated, but it's not. It's just a quick way to describe where the option's strike price is relative to the stock's current price. If exercising your option right now would make you money, it's in the money. If it wouldn't, it's out of the money. And if it's right at the break-even point, it's at the money. It's really as simple as that. Okay, theory time is over. We've got the basics down. Now let's move on to the really powerful stuff. How we can combine these building blocks into actual actionable strategies. This is the heart of what the first chapter of this book is all about, putting these tools to work in a real portfolio.
Okay, now this table you see right here, this is a total game changer. It shows that being a sophisticated options user isn't just about being bullish or bearish. It's also about what you think is going to happen with volatility. So for example, if you're bullish, but you also think things are going to stay pretty calm, low volatility, buying a call is your classic move. But if you're still bullish, but you think things are about to get really choppy, high volatility, the book suggests that selling a put might be the smarter play. See? It adds a whole new layer of precision to your thinking.
Let's dig into the single most popular strategy for investors, and that's enhancing yield. It's often called call overwriting. The idea is just brilliant. You already own, say, 100 shares of a stock. You then sell someone else the right to buy that stock from you, but at a higher price. And for selling them that right, you get paid cash, a premium, right into your account, right now. It's a way to make your stocks pay your rent.
So why does a strategy like that tend to work out over the long run? Well, it boils down to this fundamental quirk in the market, which this quote explains perfectly. Basically, the fear that's priced into an options cost, what we call implied volatility, is almost always a little bit higher than how much the stock actually moves around.
So when you sell options, it's kind of like you're an insurance company, and the premiums you're correcting are consistently just a little too rich for the actual risk. You're pocketing that small, persistent edge.
Now, besides generating that income, the book highlights two other incredible uses. You can buy put options, which act just like insurance for your portfolio, protecting you from a major drop. Or, and this one is really powerful, you can use a call option to replace owning the stock. You get almost all the same upside potential if the stock goes up, but you tie up way less of your hard-earned cash.
All right, so now you've got the playbook. But before you rush off, we got to talk about the fine print. Because in the real world of trading, knowing these little details is what separates the people who succeed from the people who get nasty surprises. So here's a question for you. If you've ever looked at a screen of option prices, you've seen that column called delta. A lot of people, even some experienced traders, will tell you that it represents the probability that an option will finish in the money. But is that really what it's telling you?
And the answer is a big, flashing no. The book makes a huge point of this because it's such a common mistake. For a standard stock option, delta is not a probability. It's a measure of sensitivity. It just tells you for every $1 move in the stock, this is how much my options price should change. Confusing those two, sensitivity and probability, is a classic mistake that can really mess up how you judge your risk.
And there are a few other bits of fine print to keep in mind. Which strike and which expiry date you pick, that's a huge decision that completely changes the trade. You also have to be aware of how dividends can affect things, especially if a company pays a big one. And maybe the most important practical tip of all, always trade options that have a lot of trading volume, what we call good liquidity. It just means you'll be able to get in and out at a fair price without any drama. So let's wrap all this up. The whole point of learning about options isn't to get complicated or to take crazy bets, not at all. It's about becoming a more precise, more effective investor. It's about adding some seriously versatile new tools to your financial toolkit. The three big takeaways from this first chapter are just crystal clear. 1, you can use options to enhance the yield on stocks you already own. 2, you can use them to provide real, insurance-like protection for your whole portfolio. And 3, you can use them to get exposure to a stock's upside, but with a lot less capital on the line. Yield, protection, and leverage. Those are your 3 new superpowers.
And that really leaves us with a final question to chew on. As you look at these 3 main jobs, generating yield, buying protection, or using leverage to get exposure, which one of those tools in your new kit could be a real game changer for your personal investing strategy?